Hey guys, it's Willie. Today I want to take a look at Kraft-Heinz company. This is one that Buffett owns quite a bit of in his portfolio. Today I want to look at it and see why exactly he owns a company like this. At first thought, it really fits his thesis of buying really boring companies. Kraft-Heinz makes ketchup and cheese and, food staples. It's not a complicated business to wrap your head around. It's pretty simple, and I think it's a really good business just from a thought perspective. This is our current price here. Looking at over the past 6 months, you're up. Year to date, you're up. You're up. 5 years, you're absolutely slaughtered. I mean, you're down by half over the past 5 years. And then all time. Good Lord. Look at this. Went from a high of, what is that? 96.65 all the way down to here. At the bottom, you were looking at a loss of almost 80%. 77%? Good gracious. That's ridiculous. So, if it was worth, 96.65 there, and is it worth 37.57 here? It's just like any other company. This sort of a fall is concerning simply because it's so large, but that's what provides us value investors with opportunities to buy stocks that are undervalued because they are underloved. Okay, anyway, on to our stock analyzer. This is the usual spreadsheet. I've done something different. I think I'm going to start using it more. Over here, I have made some graphs to show just a quick way to visualize the kind of information that we're looking at in the analyzer. I mean, it's useful to be able to see it visually here. You can see that net income and free cash flow trending in a positive direction. You've seen this big jump up and jump down and jump back up of net income, which means it's going to be more difficult to forecast net income number versus a free cash flow number that is slowly climbing up. And you're going from, that might be on this chart, you're looking at 1,000 up to 5,000. And that's a good solid growth. And those numbers are in millions. So, you're looking at 5,000 million, which would be 5 billion. So free cash flow is growing steadily. Net income is wacky. Shares outstanding. We don't like those going up. It went up a whole lot, but we've seen it kind of plateau. We'll look at those numbers in more detail here in a second. Debt. Your debt number's gone up. Total debt's your red line. I've made cash the green line, and I have made net debt your black line. The red line minus green line equals black line. Those colors don't equal what, red and green together don't equal black. I mean, I guess if you put enough together, it would probably. Anyway, yeah. So you're looking at a whole lot of debt, not a lot of cash. And then dividends are kind of crazy. We'd rather see a steady increase over time rather than the jump and then coming back down. So there was a dividend cut here, you can see that, but we've leveled off. Just a quick visualization, I feel like that helps. So here are your nitty-gritty numbers. Your revenue's growing slowly, which is expected. Your net income is not growing over the past 10 years. It's all over the place. I don't know what to say. Free cash flow is a bit more stable and a bit more consistent and a bit more growing in the right direction compared to net income. Shares, not good. I don't like shares going up. Especially for a boring company like Kraft-Heinz. Come on. Earnings per share, that's based on net income. So I'm not going to pay any attention to it. Free cash flow per share, you're having a negative number because your shares are growing faster than your free cash flow, which means your free cash flow per share is shrinking. I hope that made sense. Your shares are growing faster than your free cash flow, which means you're dividing a bigger number by a smaller number and you're getting a negative growth rate. I hope that makes sense. Anyway, dividend's growing. Well, it was, and then it wasn't. It was from zero, was growing from there, and then we've since flattened out. That's a bit of a concern that they thought that they could increase the dividend and then couldn't. That's a bit of a concern. I guess there's a COVID situation in here. And then total assets, we went from 36 billion to 122 billion in 2014 to 2015. That must have been, I guess that was the time frame when Kraft merged with Heinz. I would take a guess. Again, I haven't read any sort of statements or 10Ks or financial reports or whatever. These are always just kind of first impression, off the cuff, sort of looking at the nitty-gritty numbers right quick before I do any further research into these stocks. But there you go, there's total assets. Total debt's growing. I don't like debt to be growing. But the silver lining here is that we went from, 56 billion, almost 57 billion in 2015, and you're down to 44 billion in 2021. So they're paying down debt. I like that. I'm really, really happy with that. And frankly, I would rather see them take free cash flow and pay down the debt rather than issue dividends. I would rather see a low debt company, a much more stable company, than them try to appease shareholders with dividends. I'd much rather see them pay down the debt. There's your cash. Your cash has been growing. Okay, not much, if I'm honest. You went 2015, you had 4 billion. 2017, 2018, you're down to 1 billion. Now you're back up to 3.5 billion. Okay, I don't see a steady trend here. I don't know what to say about cash, really. I'm glad that it's been growing since 2017, but since 2016, it's down, so I don't know. Net debt, and your debt's been growing, only because you're starting from here. You're getting what I'm assuming is that acquisition, merger, or whatever, and then you're falling back down. Great. Good job, Kraft-Heinz, at paying down the debt. Good job. ROIC, really low the past couple of years. And then you've got these solid numbers. Average of those is 9.77%. So really, overall, these numbers, I don't really like some of them, but some of these growth rates are good. With assets and cash, they're good. Free cash flow, good. And then other numbers, I'm like, meh, okay. It's whatever, I guess. Metric-wise, based on earnings, it's screaming overpriced. I think that's because there's no consistency with net income. There's absolutely no consistency with net income. Price to free cash flow. Free cash flow is steady and growing, and so I think this is going to give you a more accurate number. And so it's saying that it's cheap. So I'm going to put more emphasis on free cash flow than earnings, price PE ratios, essentially. Net debt to free cash flow, that's a little high. But it is Kraft-Heinz. They are a pretty stable business. I think they'll be okay. Their cash flow is solid. Their debt is still high, though. Looks like they're going to pay that down. They should continue paying that down. Even if they were to cut the dividend and just say, look, we're not going to pay a dividend until we get this debt under control, I think that would be a good idea. Revenue growth, that's flat. That's 0%. Earnings growth, that is super duper negative, not good. Free cash flow growth, that's an error message. Let me see. 5-year free cash flow growth. Yep. So you're going from a negative number to a positive number, which is, I guess, like an infinite growth rate. I don't know. But, so your number is going to be thrown off there. Over the past 4 years, though, they have been growing. And over the past 10 years, they have been growing. So good there. Shares outstanding going up only slightly over the past 5 years, but there was this huge jump right in there. that concerns me. Is that acquisition time frame? Yeah, that's like your merger time frame. But I mean, geez, going from 300 million shares to a billion shares, come on. That's way too much. ROIC is okay. Well, it was okay. It was good. Now it's not good. So, on to our sort of idea forecasting for the future, what we're going to look at. I'm going to put a lot of emphasis here on the free cash flow. I think that's the metric that we use for this analysis, simply because it's more consistent, it is more stable. I think we would have a much better idea of where free cash flow is going to be in 10 years than we would the net income in 10 years. So I've done out the regular sort of setup. So I've grown free cash flow at 2%, given it a 10 multiple, net income 2%, 10 multiple. See how you're getting vastly different prices? You're getting $44 with free cash flow, and you're getting $10 with your net income. So I think net income is kind of throwing this off. I am much more willing to rely on free cash flow rather than net income. So I think when we come over here and split the difference, currently it's $37.57 a share. Split the difference, you're getting a $27 per share price. If we do that and put it in our IRR calculator, you're in at $37.57. You get the cash flows. You're out at $27. You get a 10% annualized return. But what I think we would do in this case is simply rely on this net income number, the free cash flow number rather than the net income number. And if we assume that we're out at the $44 based on free cash flow, you're getting 14% annualized rate of return. I think that's what Buffett sees. And really, if you wanted to say, okay, 3% annualized growth rate, which I don't think is unrealistic, give it a 15 multiple. Like I like to do a lot of companies, that's your market average. A 15 multiple is not crazy. So a 15 multiple, you're looking at 18%. I think this is why Buffett owns this company. It's because of you can rely on the stable, reliable free cash flow. People are getting scared because, the debt number's too high, the net income's wacky, all of that stuff. I think people are getting scared, but, at the end of the day, the free cash flow is reliable. If you can rely on the free cash flow to pay you, the shareholder, then that's all you need to worry about is getting paid as a shareholder. So Kraft-Heinz, I think is a good one. It's not my particular cup of tea, simply because there have been a lot of changing of tastes and everything lately. We may switch back. Kraft should be fine. They're a super boring business, which I like. But there are a couple things that I would like to see them iron out before I would buy into the company. Specifically, the debt number. The debt number seems really high to me. The net income is all over the place. I do not have Buffett's stomach for things like that, or his, his super strong, logical, absolutely analytical to a point brain to where he is just, 100% factual in this. I think my emotions would get a hold of me in this one. I really do. Where I would be looking at their net income and their debt and all this other stuff, and the issuing of shares, the cutting of the dividend. And I'd say, no, I'm out. I'm not doing this. This company is doing everything, making it look like they're in trouble. And so, if you believe free cash flow is going to stay like it is, and free cash flow is going to grow, and free cash flow is going to pay you, and you believe this company is going to be able to handle the debt and handle all this other stuff, I think you're in it. I think myself, though, the debt is worrying to me. The net income is all over the place. You're relying just on that one metric, just on the free cash flow metric to come up with a solidly good valuation. but I really can't seem to do that. And when you rely on both the net income and free cash flow forecast, you're getting a 14% return based on 3% and a 15 multiple. I said 2, 2, and 10. I think that would be where I would be looking at it, because it's a slower growing company. So you're getting a slow growth rate and a low multiple. You're getting a market return of 10%. So I'm not completely sold on it myself. Buffett, I'm not going to argue with Buffett. He's much better at this than I am. He's been doing it longer than I have. But I'd like to see some more consistency out of Kraft-Heinz. But anyway, that's my take on Kraft-Heinz. And yeah, that's really all I have to say. I will catch you guys in the next one.